Hello, everyone. Thank you so much for joining us today. I was just chatting with John outside. We were talking about so much uncertainty here in this market, and that's where I'd like to begin our conversation. John, thank you so much for speaking with me. It feels like we're in a market where headlines are driving sentiment hour to hour to hour. We also have geopolitics, trade policy, AI disruption in focus, so many things to focus on in this moment. And it's not just headlines. They don't just trade on headlines in terms of the market, but they also trade on capital flows and long-term assumptions. We were chatting about how diverse your board is at Ariel Investments, and I'm curious what it looks like if we were in the boardroom right now in this moment. What types of conversations are you all having?
That's an interesting question. We just had our Ariel Investments board meeting just yesterday here in New York City. And we have a wide range of directors. You talk about diversity. We have Martin Kramers, who's the dean of Notre Dame's business school and helped create the term active share. And we have the former senior advisor to President Obama, Valerie Jarrett, former Secretary of Education, Arnie Duncan. We have Heather Tooks, who is an extraordinary professor at Yale University, very involved in the investment world. And so bringing all these perspectives together, we think makes us a stronger firm and a better firm. And you can bet last night at the dinner we were talking about this challenges the country's facing today. And basically, the worries and fears that we all have that Iran can find a way to fight back and come back to try to harm us and hurt us in really meaningful ways and impactful ways. And that's something that is truly, I think, worrisome for our society today, that they are, thinking about that and worrying about that and worrying all of us that, here in New York, where you had what happened with the extraordinary, heartbreaking World Trade Center tragedy, will they try to find some other way to come back and hit us back in a similarly hard and painful way?
Mm-hmm. Well, no surprise that the conflict between Israel, Iran, the U.S. being involved is really dominating discussions. But I'm curious, is it actually changing how you allocate capital?
Well, for us, we think this creates opportunity. We're long-term investors. Our logo is a tortoise. It still is, reminding people that patience wins. And our capitalist democracy is the best system ever invented. Warren Buffett always reminds us of that every year at the annual meeting. So we'll get through these challenges. We'll come back better and stronger. He always talks about the best time to be born in America is today. So I'm really taking advantage of this opportunity with all the volatility to buy some of our favorite stocks that we think are selling at much better prices today than they were a week ago.
And so what are some of those sectors and names that come to mind?
I think a favorite sector wouldn't be surprising is there's the financial services sector. We have some wonderful businesses like Jones Lang LaSalle, JLL. Real estate brokerage is a really important business in the world. And they've been hit basically based upon the fears of the economy, but also the fears around, will AI disrupt the commercial brokerage insurance business, which we don't, real estate brokerage business, I'm sorry. We don't think that will be long-term impactful. They will, always are going to need a great real estate broker. If you're a CEO thinking about moving your company or moving 100 people from one office to another office, one campus to another campus, those are complicated, complex transactions. You're going to need the kind of talented people that are at a place like JLL. Other companies would be, you think about all the deals that are happening today. Every day, companies are spinning off companies. People are buying companies. We see what's happening with Paramount and Warner Brothers. You see that the regulators are allowing transactions like that to happen again. So a company like Lazard, that's one of the major investment banking brands in the world, they're going to have a great, great year as investment bankers helping these transactions occur. And they also have a great international and global investment management business that we think will benefit from people investing in bargain stocks around the world. And then finally, a favorite is Carlyle. We think that private equity is not doomed forever. We've seen all the companies that have been collapsing this last week. You watch on TV, you see Ares and KKR and everybody getting cheaper and cheaper. But we think Carlyle is really well positioned. They don't have the same exposure to the software companies, and also they're not, they're really, where they're focused, they're really in a great spot. They've got a great brand. They've been very cautious and conservative. They haven't been involved in, where the debt markets have sort of been under siege. they're less exposed there. The private credit market is not a big deal for Carlyle. So we think that David Rubenstein and the founders created a great brand there, and there's real opportunity. And we think literally it's only a little over 10 times earnings, really a cheap stock.
Well, are there any areas specifically in the credit market where you do feel a bit concerned?
Well, I think you want to be concerned about these hot markets. This does remind me of when the internet bubble was booming at the turn of the century, and everyone wanted to buy the same .com companies. We think that's happening with these AI companies. Everyone is so excited about it, and the data centers are all the rage. Everybody wants to own a data center. Every real estate person I know, many public companies are investing in that way. So that would be a sector that I would be really concerned about, things that are really tied to AI and companies that are sort of jumping into new industries for the first time because they think that's where the economics are going to be really positive. So I'd be very cautious of anything AI connected, especially companies that are really not truly world-class at it.
So, John, just about 2 years ago, today almost, we had a conversation, myself and a few other Bloomberg colleagues, and you said that the market was ripe for a correction, and you also said that Mag 7 stocks, the rally was overdone there, and it feels as though today we're sitting here in 2026, and it seems as though people are concerned about artificial intelligence again. So I'm curious, you spoke a little bit about where you stand today, but are there any names that are appealing to you, or any sort of stocks in particular, I should say, in the sector more broadly that you do think have more room to run? Or is it all of the bet on artificial intelligence is a bit too extreme?
I think what happens when these types of booms happen, there's so many companies that everyone gets excited about. There's going to be a few that'll be the long-term winners, but it's very, very difficult to see that. In this country's history, there was many, many automakers before things focused on Chrysler, General Motors, and Ford. Saw the same thing in the airline industry. Saw the same thing during the internet industry. So we think this is the same way today. You're trying to pick which are going to be the ultimate winners is exceedingly difficult.
Well, let's zoom out a little bit, because we talked about the fact that the macro environment is a little bit crazy right now, to say the least. What's the biggest macro variable that you think that investors are currently mispricing?
I think they're probably mispricing what's happening with the tariffs. We know the Supreme Court. I think that ultimately the courts are going to decide that because the tariffs were illegal, that companies are going to have to be paid back the tariffs that they've already paid. And I think that flood of money coming into the corporate coffers of major American businesses and smaller businesses throughout the United States will be a real tailwind that people really haven't factored in. And everyone thinks that there's going to be ways that the administration will be able to get around that and stop that from happening. I think that's what's really mispriced. It's going to be very hard and difficult to do once the Supreme Court said these tariffs were illegal.
So I also want to talk about the idea of patience in value investing. You echoed that. You brought that up a little bit earlier. We know that a lot of people say that value investing has, quote unquote, become a dying art. Some people are saying that, especially when we think about the market being dominated by artificial intelligence, passive flows, momentum as well. How important is patience in value investing, especially when markets may misprice assets for extended periods of time?
Patience is really critical as a value investor. You have to wait until you can buy a great business at a bargain price. And then you have to be patient, as often a company maybe it's going through a temporary crisis. They're having some difficulties that are having to get through, and you have to be able to look out again over the horizon and see what that company will look like when the sun comes out again and the storms drift away. And I think that that's where the great value investors are the ones that are able to invest with that 3 to 5 year horizon, not get so fixated on what's happening each quarter, whether a company missed or didn't miss, but looking to see if that long-term strategy is still in place. Is there a true moat around the company? Does the company have a balance sheet to weather the storms? And a management team that's laser focused on hiring the best people and treating their customers fairly and appropriately. And also deeply, management teams that care about their shareholders. If you keep your eye on that long-term prize and not get swept up in the short-term noise, that's how value investing really works.
So let's talk about value traps then. What's a classic value trap to you this year? And what are some telltale signs that a stock is cheap for a reason versus just being genuinely mispriced?
Well, that's really, really, really difficult. It's, And behavioral finance teaches us how hard it is to, sometimes just being human beings, to avoid a value trap. It's really, really, really difficult. But I think what you have to try to do is really what we've tried to do at Ariel is have a devil's advocate on every industry that we follow and every company that we follow that can come in and challenge the thesis that we have for that company. And that makes it, it makes it easier for someone to challenge what the analyst is thinking and what of us seasoned portfolio managers are thinking when you have someone assigned to be that devil's advocate. I think the other thing you want to keep asking is the moat still there? And companies all the time try to tell you this is just a temporary problem. They're going to be able to resolve it. And human nature, you're sort of rooting for the company to get back on track. But if you look out over the horizon, you see that the moat isn't going to be able to withstand competitive pressures, or the industry is not going to be able to grow the way you had hoped it would be over the long run. Those are the companies to try to avoid and for us and stay away from. And there's sectors like that. One of the things I think what's happening, the way Americans no longer are drinking alcohol the way they used to. So, for us, it's be very difficult for us to buy a cheap, cheap beer company or a cheap spirits company. But there's many examples like that where industries are completely transformed and it'll be very difficult for them to get back on track and grow again.
Well, also we're dealing with this higher for longer rate environment, people concerned about the outlook for interest rates. Are you seeing a different universe of companies that you would say are showing up as cheap today versus maybe 5 years ago?
I think that what I really think are the cheap, a lot of the industrial companies that manufacture products that people often need from the auto industry. I think that's a sector that's been sort of out of place for quite a long time. They've never really had their day in the sun to really have a really strong comeback. I think a lot of the housing related companies, a favorite stock of ours is a company like Mohawk that makes carpeting. Just a very mundane, very important, solid business. It competes with Warren Buffett's Shaw Industries and their carpet businesses. But we think that'll be something in the long run will work. So those are sectors that I think the industrials, the housing related companies, you can find bargains, or they really haven't had a chance to really truly shine in today's economy.
What about on the opposite end? I know we talked about some sectors that you're a bit cautious on. You mentioned artificial intelligence. Is there anything else that's out there alarming to you?
Well, I think that the alarming things are, as we talked about, the hot tech stocks that everyone is owning because they're such a big portion of the S&P 500's results. And I find that when everyone feels the need to own the same names because everyone else owns them, and because they become large portions of the index, people have stopped looking at the fundamentals. They're not buying the company based upon its growth rate, management, its capital allocation decisions. They're buying it based upon what index it is. That's always a sign to us that we are getting toward the top in those sectors, in those industries, in those companies. So I think we're seeing that in many places, but primarily, as we talked about earlier, the tech stocks, the AI stocks, these large booming businesses that have just sprung up overnight, they haven't proven whether the moats are going to be strong or not. So I just be very, very cautious and careful.
I mean, do you think that at all the reaction that we did see in terms of the sell-off of a lot of AI-related names or sectors that we think could potentially become obsolete due to artificial intelligence, is that a knee-jerk reaction, do you think? I mean, because we did see this one period where people would say, you're crazy not to have Magnificent Seven stocks in your portfolio or just tech exposure in some way, shape, or form, but now you're seeing investors saying, hey, maybe not so much.
Well, what we've tried to do at Ariel is make sure that we are just not listening to ourselves, but try to get as much academic expertise. We're blessed in Chicago to be at have the University of Chicago there, and I'm a trustee there, and we've been able to get access to a couple of great professors to help us consult and guide us on where the most likely disruption is going to occur and where you have to worry the most, and then where maybe it could be a tailwind to help your company or industries that you're following, how they will do in this new environment. So it is really, it's surprising how powerful it is and where you don't always know where it's going to show up. So one of our best stocks the last year has been the Sphere out in Las Vegas. And, you can go and see the Eagles, the Backstreet Boys, and of course they've got Wizard of Oz, and it's just been phenomenally successful. But it's because they were able to use AI very effectively and efficiently to make the Wizard of Oz work within that new arena with the best sound in the world and the best video in the world. They wouldn't have been able to do that 5 years ago. And as AI becomes more and more powerful, they'll be able to take the IP and be able to make magical things happen, and in a way that'll be very cost effective and create experiences for consumers that no one could have imagined in the past.
Mm-hmm. How are you thinking about the rate environment and what that could mean for investment opportunities more broadly? We've been sitting in a situation where rates are been high for a sustained amount of time. You mentioned that, of course, the thesis of value investing, and specifically with your firm, you all are long-term investors. But how do you think about the future? How do you price that in, especially in this environment that we're dealing with?
Well, I do think that we talked about some of the positive things out there. Regulatory environment is positive for M&A and transactions. You think about interest rates. I think they have to go lower. We all know this is all front page news. We see it on television every day. We know that the new Fed chairman is going to want to make the president happy and keep interest rates low. And so I think that'll be a major tailwind as we go throughout the year once you have that transition. We think, again, the tariffs will be getting paid back. All these things are going to be helpful to create an environment that will be ultimately good for the markets, even if we do have some bumpy times along the way. But to your question, the bottom line is I would bet the rates will be lower 6 months from now than they are today.
Mm-hmm. So for somebody that's trying to navigate this environment, where should they anchor their strategy? We've got so many different moving parts and focus right now. It can be easy to feel like you're turning from side to side. We had a data shortage with a government shutdown. You spoke about tariffs, artificial intelligence disruption potentially. How do you anchor your strategy in this moment?
Well, I think for us, it's just going back and finding great companies that are we think are undervalued and underpriced. The one thing I haven't talked about, I think experiences are going to be more and more important. With AI, people are going to be working less hours. People are going to be looking for exciting things to do with their extra free time. So it could be going to the Sphere to go and see shows. It could be getting on a cruise line and going to visit the world. And so companies like Carnival, Royal Caribbean, Norwegian are really well positioned in the cruise space. A small company like One Spa that does all the spa services on the vast majority of ships, they'll benefit from people wanting to use their time more effectively and have more fun. We own a lot of stock in Madison Square Garden Entertainment that owns the Garden here in New York City. And, people are going to be going not only to see the Knicks and the Rangers play, but they'll see the residencies. Harry Styles has taken over from Billy Joel. And lots of fun, exciting things happen. People have more time for it and are willing to pay up for those experiences. So we're looking at companies that will benefit from that transition.
Mm-hmm. Has the balance between value and growth meaningfully shifted in your portfolio at all, to any degree?
We continue to be just strong value investors. Our portfolio is very cheap relative to the markets, and there are a lot of wonderful companies, selling at less than 10 times earnings that you can buy that have substantial growth anticipated, great cash flows, well positioned, and they're really cheap. And they're partly cheap because everyone had given up on small value. Mm-hmm. So the quality of the research just isn't what it used to be. And if you do the homework, you can find some real hidden gems there that will, we think, have great returns going forward. So I'd be sticking to value and feeling that that's where the opportunity is. Do the creative homework now and it'll really pay off over the long run.
What's something that, I can imagine there's a lot of things, but what's something that keeps you up at night when you're thinking about how to best strategize?
What I talked about earlier, I just do worry that the unsettling time in the Middle East and how that could just really come back to haunt us here, and in ways that we can't imagine, because we're doing things in a way that's different than maybe we have in the past, and not understanding the ramifications as a country like Iran. Iran feels the power, is incentivized strongly to fight back and terrorize the rest of the world, and especially the Middle East, and to try to destroy America to the best of their abilities. That's what I kind of worry about, that worldwide tensions that we have right now, and what terrorists can do to our country. That's what really worries me.
Well, thank you so much for your time. That's John Rogers, CEO of Ariel Investments. I appreciate a riveting conversation.
Well, thank you.